All right, welcome everyone. My name is Augustino Pintus. I'm with Bulletproof Cashflow. We've been experiencing a little bit of technical difficulties here, but thanks for bearing with us. I appreciate it. So, what we're here to do today is we're going to talk a little bit about debt, all right, and how to leverage debt to really help you build wealth. Okay, so these days a lot of folks are always on the internet chirping about how debt is all debt is bad, and that's it. It's a blanket statement that's largely made on in general. Okay, and I would have to say that for many people out there, debt is actually a very bad thing. And it's not because debt in its own nature is bad, it's because of how it's being used and the type of debt that you're using as well. So, we're going to talk a little bit about this, all right? Because I think this is a very important thing to discuss in terms of leveraging the right debt to do the right things that you need to build wealth. That's the difference. Okay. And we're going to talk a little bit about this. The interesting thing here is that the majority of Fortune 500 companies have huge amounts of debt, enormous amounts of debt. Okay. They're able to get that big because they're able to leverage debt to get to where they want to be, but they use that debt responsibly. Okay. And what do I mean by responsibly? Well, look, whenever you're borrowing money from anybody, a bank, the credit card company, whatever, they charge a fee, they charge an interest rate. Okay. Whatever you're investing in needs to beat that fee. So let's say a lender is lending money at 7% interest. Well, conceivably, the asset that you're buying that produces cash flow or the deal that you're getting into that makes money will produce way more money than what the lender is giving you that money for. Okay. So you're basically keeping the spread. So if they're charging you, say, 5, 6, 7%, and you're making 15, 20, or 15, 16, 17, 18%, you get to keep the difference. Okay, is what I'm getting at, right? It's a very simplified way of looking at things, but that's the general concept of it, using the right debt for the right deals. Okay, so when these companies use debt, all right, what they're doing is they're usually constructing their capital structure because debt has certain advantages compared to equity financing. Okay, so here's what I mean. Using debt helps keep those profits within the company and helps secure those tax savings because you can't tax debt, right? That's the other interesting thing is you just can't tax debt. So there's also other ongoing financial liabilities that can be managed, which can impact your overall cash flow. So listen, regardless, debt is absolutely necessary to creating wealth. So in this training, we're going to discuss how you can use debt constructively to both build wealth and cash flow for you and your family. Okay. So let me get into how that part works. Okay. So when we're looking at a deal, I'm going to use some round numbers. Let's say $1 million deal. Okay. And this $1 million deal, and let's say that I can get my hands on $200,000. So that means $800,000 left. All right. Where do I get this $800,000? The bank. Okay. People often hate on the banks. There's no reason to hate on the banks, guys. The bank is going to come to the table with 800K because they want to invest in this deal. Why do they want to invest in this deal? Because they know that they can charge you, say, 8%, 7%, whatever it is, right? They can make a fee off of it. It's secured by the asset and they win and you win. Why do you win? Well, because you know that with your $200,000, you apply this leverage, and maybe the return on that deal might be say 15%. Okay, so you're going to earn 15% of your money. You're going to pay back the lender. The debt is not taxed to you. It's a win-win situation. Ultimately, though, here's the thing. All right, there's a lot of hate on banks. The banks are not to be hated on. They are your business partners in the deal. If the bank doesn't like the deal, you don't do the deal. That's a simple rule that I follow all the time. If I'm putting out deals out there and the bank's not exactly crazy about doing the deal, they're not jumping up and down to the deal, they probably don't like the deal. Now, suffice it to say that if you're showing your deal off to multiple lenders and the lender maybe that lender doesn't do the type of deal that you're looking to do. For instance, let's say you have a fourplex, okay, and you're showing it to a large group that does like multi-million dollar deals, well, chances are they're probably not going to finance your fourplex. That's not what I mean. Let's say, for instance, you have a fourplex, you go down to your local banks and you go to like 4 or 5 local lenders that have been known to lend on this type of asset. And all of them give you some either some crazy rates in terms of high interest rate or very short amortization. Amortization meaning the length of time you have to pay that loan back. Chances are they don't like that loan. And you know what? Maybe you ought to reconsider doing that deal. Okay. That's the thing. All right. And another important aspect here to recognize is that when you're doing a deal, always make sure you have some idea as to where the lender, where the debt is coming from before any money goes hard, before you're stuck with a deal. Like, have an idea of where the debt is coming from. It's always a safe bet right there. It doesn't matter whether you're doing development, whether you're doing net lease, whether you're buying a multifamily, whatever the deal, it doesn't matter what it is. Okay, have an idea as to where the debt is coming from prior to you putting any money down, signing up for like a heavy duty contract or money's going hard, meaning non-refundable, right? Well, you want to have an idea as to where that's coming from. And a lot of folks usually miss the mark on that. They're very, very confident in the deal, so confident that if the money goes hard, let's say for instance you're $200,000 hard in a deal and no lender is jumping up and down to do your deal and you can't get the financing for it and your clock runs out, you're you have to give up your $200,000. It goes right to the seller of the asset if you're working on trying to close a deal. So again, the lender is your friend on these deals. The lender is putting up the debt on these deals. Make sure that the lender likes the deal. All right. So what you're doing again is like I mentioned before, use debt to level up, use debt to acquire assets. All right. So what your role would be to do is to put together these deals. And what I mean by putting them together, finding the right finding the right deal first. Make sure that you perform all the underwriting. Make sure that you do everything you need to do with that deal itself to understand the market, the people living there in terms of multifamily anyway, the who's going to manage it, who's going to operate it, who's going to repair the asset. Because again, if you're doing 16 units in the middle of nowhere town, finding people to actually work on the deal might be a challenge, right? So have that stuff figured out early on, as early as you can. The last thing you want to do again, go through all this trouble, finally put the debt on the asset, and then you have problems running the property, running the deal. You're in for a hard time, right? And you don't want to be stuck in a hard deal. That's the last thing you want to have happen to you. Okay, so the thing is these are all things that are done on the way before you start locking up the debt. Okay, and when you do lock up the debt, you can go in there with a high degree of confidence that the debt's going to be nice and this going to be great debt for the asset. And you're going to be happy because you'll be able to actually make some money on the deal too. You can make some money if you bring in investors as the equity. The investors can make money and everybody's happy. Okay. The long and short of it is that debt is necessary to create wealth. Okay. And if you use it constructively, you can build both wealth and cash flow. All right. So that's ultimately what it is. All right. So I talked a little bit about building wealth, right? Again, going back to that $1 million example, let's say, for instance, you buy the asset, you put $200,000 down, you buy the asset, the bank puts up 800K, here's $1 million asset. You're able to go in, you get those folks to come in, repair it, build up, fix the asset up, turn the units, bring up the rents, you improve the net operating income, you improve NOI, and then what happens? Then what you're able to do is maybe you hang on to it for 24 months and then you go and sell the asset for 1.2 million, 1.3 million, right? So now what do? You pay the lender back their $800,000. And now what happens too? You started off with 200K that you put into it. Let's say you sold it for 1.2 million. Now you have 400K. You got to pay taxes, you have to pay expenses, whatnot too. But you know what? Maybe let's say, for instance, you clear $100,000. Great. So maybe you split it with your investors and everybody's happy, right? Certainly, that's a very, very simplified example, but you get my drift and how to use debt for your benefit and to, of course, build cash flow because you're building cash flow through this whole time, those 24 months. You're building that steady income that's rolling in, depending on the asset, of course, and you're also building that value in the deal too. Okay, what it all comes down to is the type of debt that you're doing, right? And I think that guys like Dave Ramsey, he's out there saying, "Oh my God, all debt is bad. All debt is bad." You know what? It's it's not true. That's a long and short of it. Debt might be bad for certain folks, okay, that are not aware. And what do I mean by that? Look, consumer debt, all right, credit card debt, student loan debt, all that stuff. You're buying something that doesn't give you a return, so to speak, right? If you get a mortgage for a property, you get a loan for a property, you're getting a loan and it produces income. At least if you get a car loan, for instance, at least it takes you to money, right? At a minimum, right? But even a car loan, it's like a car loan costs you money. You're borrowing it from the bank. The car loan doesn't produce any money, right? Real estate does. Self storage does. A development, when you first get into the deal, doesn't produce any money, but once you start lease up and you get it rolling, then it does produce revenue, right? So that's the point: is the type of debt that you're getting into. And I think for many people out there, what they're doing is they're getting into they're over leveraging on credit cards. Okay, that's one thing. That's probably where the bulk of what's happening right now is a lot of folks are using a lot of credit card debt, and they're having a hard time balancing their debt and how much money they make in a year. And of course, I know times are tough these days. That's always a thing. However, it all depends on how that debt is being used. If you're using a credit card, for instance, to go and buy a course, it's going to then help you make money. That's a different story. I mean, you can do that, right? But if you're using credit card debt just to survive, eventually you're going to run out of that money, right? Eventually that debt, which is very, very expensive, 24% interest rate or higher, depending on the credit card. You should, if you don't know if you don't know what your rate is, you should definitely look at it, all right? Because you're going to be very shocked at some of these rates. Some of them might be as low as 19% annually. Others may be as 24 or 25% annually. Very, very, very expensive money, right? And again, folks at large are not even aware of how much that debt actually costs them in the long run, right? So it's one of those things that when Dave Ramsey is talking about stuff like that, about how all debt is bad, I think what he's referring to is that if you're if you don't have your debt under control, you're going to have issues. That's what he's referring to specifically. But I'll tell you, debt, when used properly, is a great tool that you can use to help you build wealth. Okay. That's really what it comes down to, is using debt to build wealth. Let's go back to that example again. All right. That $1 million example. Let's say, for instance, again, you buy a deal, $1 million deal, you put up 200,000, maybe it's your own money. Let's say, for instance, you're able to scratch and save, and you have 200 grand, and you leverage it into a $1 million deal. Okay, you leverage like a lever. You leverage $200,000 into $1 million deal. Okay, so now you have $1 million deal. You take this $1 million deal, you improve the net operating income, you improve the asset itself, you build value there. Okay, maybe even go so far as doing other capital improvements that might have been started by the previous owner. Who knows what? But maybe you did other things to even increase the value of the asset. What happens to your net worth? You started off with 200K, which is net worth, right? It's liquid money, right? They call it liquid because you could easily spend it. But you put it into this $1 million deal. And now this $1 million deal might be worth 1.2 million, like I said before. Let's say, and you want to hang on to that deal. Let's say, for instance, that instead of selling it, you hang on to it for, like, say, 3 years, okay, 4 years, even longer. Let's say five. So now this asset might be worth, maybe you bought it for a million. You make all these improvements, you improve the NOI, you do all those sorts of things, and now it might actually be worth 1.4 million. So what happens? Well, when you're calculating your net worth, and again, I'm using very simple numbers here to try to keep things easy here, but net worth, you're taking that money from the lender. Okay, so that's 1.4 million minus the $800,000. Okay, how much is your net worth? All right, on that one deal, your net worth is not 400K, right? I'm sorry, 600K, because I forgot to include the $200,000 you already put into the deal too, right? So what did you do? You amplified that original $200,000. You amplified it for your, so you put the 200K in the deal plus another 400 that now the asset's worth, right? That's how companies build wealth. Companies do the same thing. All right, they do the same thing as individuals like you and me. We all do the same sort of thing when we're trying to build net worth. Same deal. Okay. Again, oversimplified example, just so you understand what I'm doing there. But I want to give you an idea as to how net worth goes. Now, let's say, for instance, if you go to sell the asset, we sell it exactly for 1.4 million. Hard to say. You can get a BOV, a broker opinion of a value is what the term stands for, or you can also um, go and look at other assets around the market and see what the similar assets are trading for to give you a rough idea as to what it might be worth. When you go to sell the asset, you're going to have costs, you're going to have fees, whatever. But the point is, you're going to be way better off than when you started with $200,000 liquid over here, when you built up all this value and you're at 600,000 now, right? Because you took this asset that produced cash flow all along the way, by the way. If you ran it properly, it's making money all along the way. And you're also building value. When you go to sell the asset, the next buyer is going to use debt the same way you did to go and acquire the asset, more than likely. And they're going to count on the cash flow that it's generating to pay the mortgage the same way you did. They're going to count on that to pay the mortgage and to continue building that worth for themselves down the road. Right. So that's a great thing about real estate, guys. With real estate, it's really the only game in town that allows you to do those sorts of things where the price of the asset continues going up. Again, depending on the market, there's a lot of dependencies here, and it continues going up in value. And if you improve the asset and you make it a place where people want to be, they want to live, you're going to find that they'll actually pay you very, very well to live in that asset, to live in that unit. There's a great deal more when it comes to creating a sense of community and creating a home for the people that live there. That's a whole other discussion. I wanted to talk about today was specifically about debt, okay? Because I want to try to dispel this whole thing about how debt is such a bad thing, okay? And it really isn't. Debt is not, it's not a bad thing. It all depends on how you use it. You know, like and real estate is one of those few things where you can actually do great things with debt to actually produce income. It's one of the few things you can actually do it. You can't do it with the stock market. I mean, conceivably, I guess you can get some sort of line against equity that you already have elsewhere. But it's like basically it's a loan, is what that is, though, right? It is a loan, but you're tying up other equity to borrow against it. So it's a little different. You're not investing in something that generates cash flow, right? And what the key thing here is cash flow, right? So there's five things that I'd like to look for when I'm taking on debt. Okay, and I'll just go through them here really quick. So the first thing is, does it create wealth? Okay, does it create something that's more valuable than what I borrowed? So again, I put $200,000. I'm borrowing $800,000 to buy $1 million property. Is it going to be worth more money down the road if I fix it, if I improve the asset, if I drive rents up even higher to make it a great place for people to live? If the answer is yes, then yes, that's some good debt to apply, provided that it checks all the boxes in terms of the cash flow, the amortization, and the lender is happy doing the loan. Okay. The second thing I like to do is, does it provide good leverage? Okay, so um, what I'm looking for is to get decent leverage on the deal. What I mean by leverage, I used a term earlier. When I mentioned the $200,000 and they give you $800,000 for $1 million loan, that's 80% leverage, right? So that used to be the norm, I'd say 4 or 5 years ago, 80% leverage on a multifamily deal. These days, it's more like 75%, maybe even 70, depending on a variety of different things. If you're doing development, it could be 60, 65%, right? So even lower, right? And that's because for many folks out there, it's believed that development carries a higher level of risk. To some extent, it does because the asset's not cash flowing yet. But that's a whole separate discussion. But technically, if you're doing a good deal, and the type of deals that we do anyway are urban infill, so we know that there's already a lot of traffic there, and we know that we're reasonably certain that people are going to go ahead and lease up the space. That's the types of deals that we do, right? But anyway, the leverage is important too. How much can you leverage that money, that the equity that you're putting into the deal? All right. Number three, is the interest tax deductible from the earned income? Okay, like I said before, you can't tax debt. So if the interest is tax deductible, like in this case, like in a mortgage, for instance, then thumbs up, you're doing great. Number four, does it provide cash flow in excess of the cost? And again, real estate checks the box there all day long. You can buy an asset, and multifamily asset that's already stabilized or running. And if it's producing cash flow the entire time, you can pay your investors, keep them happy, and of course, continue investing in the asset to make it better. So you can either sell it down the road or refinance and pull out equity too. And number five, can you depreciate the asset? This is something I've not mentioned yet, but the cool thing about doing these types of deals is that you're able to depreciate the asset. Okay, so what does that mean? That means that you're able to get a savings on your taxes when you're able to basically to depreciate the asset over some sort of amount of time, and you take it on your personal income. So it's almost like a loss, a paper loss, if you will, right? So it's a great way to help offset some of the income. A lot of high net worth individuals use that tool to help offset the taxes they end up paying, right? So if you happen to be one of those folks, go ahead and reach out. We could talk more about that. I want to stick to the topic here about using debt. So at any rate, my point to all this is that as you're going through and looking at different tools to help build your net worth, okay, debt is the primary tool that you're using, and banks are your friends. They are your partners in the deal. They are your biggest investor in the deal. Okay, they're the biggest investor in the deal. And the third thing, most important of all, if the bank doesn't like the deal, chances are it's a bad deal. All right. So always understand where the bank's position is on the deal itself. And if the bank is not jumping up and down crazy about the deal, loving on the deal, maybe I ought to reconsider it. I always use a broker when I'm a debt broker when I'm doing these deals, because the debt brokers know and can match up the asset with the right lender. Okay. I'm really big on that. Sure, it costs extra money for that, but you know what? If 1% is going to kill the deal, then maybe you shouldn't do the deal in the first place. Seriously, right? Always get a lender broker to do the deal and make sure that they know all about the asset, and the lender is very clear as to how the capital stack, meaning all the money that's coming in to fill out where all the money is coming from to do the deal, is all there. They need to properly understand all that. Okay, absolutely key. All right, guys. Well, if I'm just looking at the time here, if you guys have any questions about how to do this stuff, go ahead and drop it in the comment section. But also, we do these every single week. Okay, so every single week we're doing some sort of training here, and we put it out here, and it's totally free. And just because I really want to try to help people learn and get into this real estate game, right? It's one of those things that when I worked in corporate, it wasn't available to me, or at least I didn't know how. So this is why we do this, to try to help other folks get into the game too. Okay, so that's it, guys. Thanks for tuning in, and I will see you later. Bye.